Hi everyone. The objective of this session is to learn about merger and acquisition at an introductory level so you can complete your assignment in corporate valuation. For this session, I made a special Excel. You can download it from the Academy City website in special topics. If you click on merger and acquisitions, or in the model, I also added the same Excel. So you can click and download it. Let's look at the Excel. The Excel, there are two folders, one for merger and one for acquisition. For your paper, you really need the acquisition, but I think it will be a good idea to understand how the merger works, okay? So let's look at it. Let's say we have two companies, company A, company B, just to emphasize that it doesn't have to be the case that a big company buying a small company. Could be even equal size companies that merge together or one by the other one. In this case, I just put the company A and company B, almost they are identical. They have the same assets, cash and other assets, total 1,000. They have debt of 700 and equity of 300. Both companies are the same. What happened in a merge? In a merger, you just collect all the assets, collect all the debt, and collect all the equity, and you get consolidated financial statements. And that's what we have here. So how did we get to the 1,000? It's simply the sum of the cash, the sum of the assets, and the sum of the liability is 700. And then the equity becomes to be 600. Very important point to emphasize. The shareholders of B and the shareholders of A, they become to be a shareholders of company A and B, okay? In another word, we take two companies, we merge them together, so we merge all the assets, all the debt, and all the equity, and then the shareholders stay to be as a shareholders of the new company. Very simple, very straightforward. Of course, it's created a lot of questions. How do I do analysis of a company that have financial statements before the merger, and now you have consolidated financial statement after the merger, but that's for an advanced course. So we'll leave it open in that point. For your paper, you mostly need this case. And here we have acquisition. I took specifically the same example. Company A, company B are the same size. And here, how the consolidated financial statements will look like in the case. And let's start was a simple case. I will also explain what you have in the bottom here. Okay? I will assume the first case that company A have acquired company B, and in acquiring the shares of company B, they paid exactly the book value. The book value is 300. And if they paid 300, that means the cash in company A went down to 200. After you have this kind of a case, what will look like the consolidated financial statement from A point of view, because A acquired B. How much cash together they will have? Okay, in this case, we have 500 minus the 300 they have paid the shareholders of company B. Let's leave us with 700. So the 500 minus 300 plus the 500. How much assets we have? 500 plus 500. From the assets point of view, if you look at it, we have 1,700. In fact, this is different really from what we had before in the merger. In the merger, we had 1,000. Why? Because we combined all the cash. Nobody have taken a cash and moved out. In this case, company A is paying the shareholders of company B 300, and the shareholders submit the shares to company A. Okay, therefore, company A, after the acquisition, will have only 200 in cash, but adding to it the 500 of company B, that leaves us with only 700. The asset stays the same, 500 plus 500, and goodwill 0. We'll come to that in a minute when we'll deal with a different case. There's no such a thing as minority interest, and that one also I will explain in a second. What about the debt? That is the 700 plus the 700, just like we did in the merger. And then the equity of company A stays the same. Looks totally confusing. Totally confusing. But let me do something that can really make your life and explain the process. It's a little complex and very confusing at first. But let's do something which I think will help you just to understand the process. Let's look at the company A. How do I prepare consolidated financial statement from scratch? Let me delete all the numbers and go step by step. Okay, what's the process that can help you understand the result that we just saw now? Stage number one, before we do consolidation, we simply copy the numbers of company A. Company A has 700 in debt, they have 500 in cash, and they have 500 in assets, and they have 300 in equity. In another word, I ignore the yellow colors, they don't exist, and I just really copied company A exactly as it looks like, the balance sheet of company A. Now, what happened? Company A paid for company A 300, therefore they have left with 200. I should really add another account here, okay, and call it investment in B, meaning how much I'm investing in company B. I'll make it a little bigger here so you can see it in B. Okay, how much they invested? They invested 300. In another word, the balance sheets of company A have changed slightly from having a cash of 500, the cash went down by 200, and my investment in company B is 300, reflecting the fact that we purchased the shares from the shareholders of company B. Pay attention. The shareholders of company B gets the 300 and walks away. He is not an owner of company B anymore. The owner of company B is company A. Now, knowing that the 300 reflect the holding in company B, we're trying to present the 300 as representing the balance sheets of company B. I will repeat that. The 300 here, after all, presenting the 300 of this equity. Now we want to do consolidations. Consolidation means let's present this 300 as the total assets of company B minus the debt, which gives me exactly the 300. Okay? Doing that, I'm deleting this number in here. Let's delete now this one because I'm removing this 300 and I'm adding the 300 in a different way by adding the 1,000 on the right side and the liability on the left side. So the 700 turned to 1,400. The 200 turned to 700, 200 plus the 500. That will be 700. And then the total assets, I had only 500, I'm adding the 500. So it becomes to be 1,000. In another word, we removed they count investment in company B and just simply added the total assets minus the debt. Let's reflect the 300. And no surprise, the balance sheet balance. We have 1,700 in the right side, 1,700 in the left side. In this simple case, we do not have any account like goodwill or minority interest, which I'm going to explain in a minute. The consolidated financial statement in case number one, in which company A buying 100% of company B and paying exactly the book value of the equity of company B. So that's really the way this one looks like. The nice things about this Excel is when you put 100% here and you put the amount you paid, automatically this part adjusts accordingly. Let's move to another case, okay? Let's move to another case. A case in which company A purchased 100% of the stock of company B, but in this case, they're paying not 300, let's say they're paying 500. The nice things about this little simulation is that it just automatically and give me the results. If you notice here, all of a sudden we have a goodwill of 200. Now you ask yourself, what is this 200? Very simple. Before we paid 300, there was no goodwill. Now, if I paid 500, that means for a stock that worth in the book value 300, I am paying 500. That means that I'm paying extra of 200. Therefore, that extra, the name of that extra, it's called goodwill. So let's do the same exercise here again, okay? And see how we're getting these results. So let's start all over. I have here 700. I'm just copying again the book value of company A, and from there I will start, okay? Company A bought the shares of company B, paid 500. So the cash becomes to be 0. Investment in company B will be also 500. Balance. That's the way the non-consolidated financial statement looks like. Okay, that's before we consolidating. Okay, very simple. Cash is gone because it went to the shareholders of company B, and we have a new account, investment in company B, 500, it balanced, everything looks like the same. By consolidating company A and reflecting the fact that company A is controlling company B, we have to do a very similar exercise as we did before. We're going to remove this 500 and we're going to reflect what this 500 reflect. So first things it reflects goodwill. That's the extra that we paid. That will be the 200. Now, what is the 300 that left? We just adjusted the 200. What about the 300? Now the 300 becomes to be like the previous exercise. We will remove, we will add the total assets, sorry about it, we will add the total assets minus the total liability. That will give me exactly the 300, which are missing here. So here we go. Let's add to that the 500 of company B, add to this one the 500 of company B, and on the left side, we will add the 700 of company B. That will be balanced. In this case, we have a new account called goodwill, which reflects the value of that company A attached to the value of the equity of company B above the book value of company B. That's the extra amount that company A paid for the shares of company B. Let's take the last case in which company A is buying not 100%, but Let's say 80%. Let me make a point here. Why I'm using 80%, not let's say 40%. The rules are, the accounting rules are that you do not do consolidated financial statement unless company A has substantial influence on company B. An automatic rule is that company A has substantial influence on company B if company A purchases above 50% of the stock of company B. So as long as company A buying more than 50% of the shares of company B, company A has to prepare consolidated financial statements. So that's why I'm using always cases above 50%. Let's assume it's 80%, and let's assume they paid 400 for it. Let's do the same exercise again. What happened now? We're buying only 80%. So let's start all over here. I will erase here, put the 700. That's the way the books looks of company A before the acquisition. This one is also 500. And here I'm going to write 0. And I'm going to delete this account also altogether. Okay, by buying 80% of equity of B, the book value of equity of B is 240. It will be the 300 times 80%. That's what give me 240. That's the value that company A is really buying from a book value point of view. They are paying 400, so I can say that the difference between the 400 and the 240 is a goodwill. It's the extra they paid above the book value. So let's first of all do the acquisition without the consolidation. In another word, since company A paying 400, the total cash of company A went down by 400. That means that here we have only 100, and investment in B will be also 400. Of course, the balance, it's still balanced. That's the way it will be non-consolidated. Okay, this is non-consolidated. Consolidated financial balance sheets of company A. If I want to do consolidation, I will have to take this 400 and present it as we did before. So, okay, so let's do the consolidated now. And we'll get exactly the results that the simulation does automatically. The 400, I'm going to split to two parts. One is a goodwill. The goodwill is exactly the difference between the 400 and the 240. This is the extra they paid for. So 160 will be a goodwill. Very similar to what we did before. That's the extra I paid. Now, since for 400 I reduced it to 160, that means on the right side I'm missing 240. This is the book value investments in company B, but that's no problem. I'm going now to add the total assets and the total liability as we did before. So the cash to the cash, I'm going to add the cash of B to the assets. I'm going to add the assets of B. Oops, what did I do wrong? Let's do it. Let's start the plus here. Okay, and then for the liability, I'm adding the debt of company B. But you should ask, oh, Amos, in fact, you should added only 240 and you added a 300. Why did I add 300? I took the total assets, I took the liability, total assets added to the right side 1,000, the liability added 700 to the left side. Net, I added 300. So, but I should have added only 240. So of course it's not going to balance. There are 20% of the shares of company B, which company A did not buy, and they are being held by other people that didn't sell the shares to company A. Those ones considered as minority interest. And there's new names today for that under the IFRS, which you can see in the balance sheets when you see your company. And how much that should be? It's exactly the 300 minus the 240. Or in another way, 20% that company A did not buy, it's exactly 60. 20% of 300, it's 60. Now it will balance. And that's exactly the result we got in the simulation. So let me delete here everything and summarize everything. Okay, let's look at that. In the first case, we bought 100% and we paid exactly the book value. There is no minority interest and there is no goodwill. I paid exactly the 300, therefore, by adding the cash and the liabilities, and the equity do not change because the equity is the equity of the shareholders of company A, and that's in any case did not change. Okay, simple case, buying the whole shares of company B and paying exactly the book value. So whatever I paid, I replaced by the difference of the total assets of B minus the total liabilities, and that's balance. Case number two, I'm buying 100%, but I'm paying more. Let's say I paid, 500, as I did before. In this case, I am paying 200 extra above the equity book value of company B. That's come into place just by the extra that I paid, it becomes to be a goodwill. In the first case, I had 700 in cash. Now I have only 500, but I have a goodwill, the extra that I paid above the book value of company B. The last case was that I purchased only 80% and I paid 400. In this case, not only I am paying above the book value of 80% of 300 is only 240. Okay, so that means if I'm paying 400, I'm paying 160 extra. That's come into place here. Then the 20% that I did not buy are being reflected by the minority interest. If I reflect the minority interest here, I have to add all the total assets and the liability to the balance sheets of A, and then it will be balanced. In other words, I had 100 because I paid 400. The 500 went down to 100. I had 100 to 500. I get the 600. The 1,000 is simply the total other assets. Give me the 1,000. 160. It's the extra I paid for the book value. 1,400. It's the debt plus the debt of the two companies, and the minority interest reflect the part that company A did not buy from the shareholders of company B. That's summarizing simple acquisition cases. I already covered most of the cases that you might see. Now let's go into and think about what's the meaning from our valuation point of view. When we do consolidations, pay attention that the minority interest is like another shareholders. So when we do a valuation and we do a cash flow, discounted cash flow, we're valuing the total assets, meaning evaluating the right side of the balance sheet. If we get a value and we want to get into the value of the equity, we must take the market value of the total assets, subtract from that the debt, and then subtract the minority interest. Let's look at the simulation for a second. That will give us also the opportunity, okay? And I will show how the simulation works. The nice things about the simulation, it gives you also all the numbers. By the way, if you notice, there's a new button here called simulation, which takes you to do really a simulation. Let's take one of the companies that I know that one of your groups are using. Let's go into all companies. That's in case you don't know really in which industry it is. Let's automatically pull all the over 30,000, over 3,600 companies. So if you start typing let's go for Netflix, okay? I'm going for Netflix. It automatically gives me the data of Netflix. Here you can see really all the data of Netflix from 2012, 2018. I'm continuing in calculation, very similar to the way that you have in the Excel. Country, and which country Netflix mostly operating, it's United States. So I'm going to pull United States. Let me try that again, United States. Good. And here it's automatically pulling which grading the country has, or the tax rate in the country. If there is any country risk, it's automatically picking it up. For example, if I pick the United Kingdom, you will see there is a spread for country risk, and it does the whole thing automatically. But since Netflix is mostly operating in United States, I would pull United States. Then finally, for which year I want to do the valuation, since the last year you have a complete financial statements 2018, we're going to use 2018. Now you can see that this part is automatically filled up for you exactly like in the Excel I gave you. So you should really see similar results. Okay, if you don't get the same results, or you have an error, or you didn't pull up the right numbers from the financial statements, please advise the folder of data, make sure you're getting the same data as I get here. There might be differences, by the way. These data are coming from the SEC. It's the and companies filing it in a format called XBRL. Sometimes there are differences between the way they actually publish to their shareholders to the way they report to the SEC. If you see a big differences, you really must explore why there is a big differences. There shouldn't. And please call me or contact me or call the TA if in case you see a big difference. If there is a minor differences, just ignore it. And the difference is because many reasons. One of the main reasons is really the way the reporting or the way it might be even a typo. Okay. The second part is cost of equity. As we learned in the class, we look at the industries in which this company operate. For Netflix, I would say entertainment is probably the closest one for it. So I would choose entertainment. In case there are more than one, I will just add another row. Adding another row just by clicking Add Industry Data, and here I could choose another industry. What the amount I'm supposed to write here is the total revenue the company is making in each segment. If they had two segments, they should have a notes to the financial statement stating how much is the revenue for every segment, okay? In the case of Netflix, there's only one, I think, so therefore I'm gonna delete this row. Deleting a row is just simply by clicking the delete. It automatically give me the beta, give me the growth rate from the right data. In your case, in the Excel, it comes from the correct folder, and you should get the same result as I'm getting here. So cost of equity should be 8.54 for Netflix, and debt should be 3.3%. Those two will give me the results for the WACC. If you go now to the folder of valuation, it's automatically putting the WACC, calculating it exactly as the formula we learned in class. Okay, the rest is data is putting for 2000 EBIT for 2018. This one is in millions. Give me the marginal tax rate, exactly as we have here. It does really all the work for us in a nice way. This one is effective tax rate, by the way, as we learn, and you have it in the second folder in the Excel. Here it does automatically. How does it do it? Takes all the actual taxes, add them up from 2012 to 2018. In the Excel, I gave you only a place for the last 3 years. That's really also discretionary. If you think really that the previous years are less relevant than the last few years, you can ignore them, okay? But in this case, I took from 2012 because I had data going back to 2012. I added also, and also I took for operating income, that's the EBIT, I added them up. This divided by this give me the effective tax rate or the actual tax rate. The other one that we calculate is a return on invested capital, exactly as we learned in the class. We take total operating and we take total operating divide by the sum of total long-term debt plus shareholders. In other words, operating divided by the sum of total debt and equity. That gives me return on invested capital of 6.18. Quite normal for a big company like this one. Now let's go back to the evaluation. And now that I'm looking at all of that, one thing that I look at is reinvestment rate. I leave it to you as an exercise. How did I get to this number? Okay? How did I get to this number? Okay? Look up your books and look up in the equation of Gordon equation. It's in parentheses, like as a hint. Okay? Is reinvestment of 74, it's too high? Seems high to me. Okay? So that would raise maybe a question. Maybe our calculation are not perfect. Even if we're going by the rules, maybe we have to think about it. And let's see. Let's look at the results. The company, the shares are traded for $267 per share. On the other hand, our valuation giving us 42. Are we totally off and the market is right? Or the market is totally off and the valuation is good and we should expect that the share value of Netflix to go down? Well, to make sure that I'm not really off, a good practice is to say, well, where I might have gone wrong. Let's say that the WACC, okay, it's too high. That's why we're getting such a low value of the shares. So how about if we reduce even the WACC to, let's say, 3.5? I really hardly can see a company like that having a WACC lower than 3.5. Let's leave the EBIT because it's a fact that we cannot really control. It's coming right from the financial statement. How about if our estimate of the short-term growth were too low, okay? And let's assume it's even higher. Let's say 6%. I am even doing it higher than what I really estimated from what analysts told me. Let's see what the effect of that. Yeah, it did raise my expected valuation, but still it's far away. Okay, so even those two corrections did not really bring me even close to what it's being traded for. Let's go and see another thing. Is the long term affecting? Let's say raise it, let's say even to 3%. Okay, I'm doing all the assumptions just to see if my valuation, what might hold my valuation to be too low, and release all my calculation and make them even higher to make it to be to overestimate the value of the company. The effective tax rate is 4.97. This is really reflecting the past. So how about if we really exaggerate and make it that forever they will pay only 5%. They will never pay 25%, as companies should pay in the United States. Okay? Is that going to affect the value? Yes, it does, but it's only 80. Still, I have a huge difference. What does that mean? That's a really a red flag, meaning I should really expect in some time in the future something going to happen, because those numbers are really more than reasonable, and they are overestimating what I really think this company might grow. I can't really see the company growing more than that forever, more than 3%, which is more than the GDP in the US expected to grow in the future, 6%, and much above what I expect. You know what? Let's even exaggerate, make it even 8%, which is unlikely to be for the next 5 years for a company like that. Still, I only went up to 85. So a conclusion I might say, here I have really a company that I should really watch for. That's a good candidate to follow. Is the company is going to dive in their price? I assume yes, frankly. When it's going to happen, it's a different question. A company in this size usually takes much longer to adjust their actual price to intrinsic value. This is a really excellent example to see how the value that the company is being traded much above what we really by intrinsic valuation see. Okay, I hope this has really helped you to know what to do in your paper, and good luck.